Let's talk about the elephant in the room. You're working twice as hard as last year, probably scored way more billets compared to 2024 already, but for some reason your bank account isn't growing. Wanna know why? Most likely it's your profit margins that are shrinking fast. If this sounds exactly like you, then you're in luck and you came to the right place. Today, I'm giving you 5 key strategies to flip that script. Actionable steps that you can easily implement straight away. Let's get to work. Let's get one thing straight before we dive in. Revenue means nothing if your profit margins are at zero. I've seen contractors get excited about hitting $1 million in revenue, but after materials, labor, and overhead, they're barely taking home enough to pay themselves. Profit margin isn't about how much money comes in, it's about how much stays in your pocket. Imagine this, you land a $500,000 roofing contract. The crew does a great job, the client's thrilled, but when you add up material overages, overtime labor, and equipment rentals, your profit shrinks to just 4%. That's 20 grand for months of back-breaking work. Not exactly retirement money, right? Now, think about a contractor who charges $50 an hour, but only keeps 8 after expenses. Then picture another one who charges 65 and keeps 22. Who's funding their kids' college? Who's still grinding weekends trying to make ends meet? The math doesn't lie. That's why today I'm finally sharing the 5 strategies that my clients and I have used to help keep more of their hard-earned money without cutting corners or overworking themselves into the ground. The first thing you need to do is uncover hidden cost leaks. I actually have a YouTube video about this where I revealed the top hidden profit leaks that most contractors missed. Linked it here so you don't miss it. Most contractors don't realize just how much money they're bleeding on unnecessary expenses. It's not always the big purchases that kill your margins, it's actually the small leaks that add up over time. Let's start with a hypothetical. Say you run a framing crew. Last year you pulled in 1.2 million in revenue but only kept 6%. Where did the rest go? Maybe you're using outdated cut lists, wasting 15% on lumber, or paying for software subscriptions you forgot to cancel. Maybe that excavator sits idle most days of the week, but you're still paying $400 a day for it. These leaks add up fast. Here's how to plug them. First, review last month's expenses and flag anything over $500. Then ask the brutal question, does this expense directly put money in my pocket? If not, it's on the chopping block. If you're still paying $800 a month for project management software you're barely using, you should cancel it. Be savage about where your money's going. I had a contractor go through this process and found $28,000 in annual waste. That's a new truck payment. That's a family vacation. That's a whole lot of extra cash in his pocket that could have gone into his retirement fund. The second strategy is supplier negotiations. Most contractors stick with the same suppliers for years, assuming they're getting the best deal. Spoiler alert, they're probably not. Think about it. You've been buying from the same guy for 5 years, but prices keep creeping up. Instead of asking if they can lower the price, flip the script. Say, we're committing to $150,000 in materials this year. What's your best bulk rate? Suddenly, you're not just another customer, you're a valuable account. And don't stop at pricing. Payment terms matter too. If you're on net 30 terms, ask for net 60. That extra month of cash flow could cover payroll during slow seasons. A drywall contractor I worked with renegotiated 3 supplier contracts and boosted his margins by 3.5%. That's 35 grand straight to the bottom line on $1 million in revenue. The third strategy is streamlining your service mix. Not all jobs are created equal. Some make you way more money than others, but if you are taking every job that comes in, you're probably spreading yourself too thin. So in short, if you are not niching down or sticking to one specialty in the industry, you are making out to be a generalist who's potentially losing more cash in your pocket than you can imagine. Let's break it down. Say you offer fencing, decks, and custom pergolas. Fencing is in high demand, but every contractor in town undercuts prices, so you're barely scraping 8% margins. Decks are steady work, 15% margins. Pergolas, fewer clients, but 32% margins because it's a specialty. So where should you focus? You know the answer. But most contractors take whatever jobs come in, even if they're not profitable, because spoiler alert, not all contractors evaluate their profit margins either. That's another story. That's a huge mistake right there. I had a landscaper client who stopped mowing lawns and focused solely on high-end patio installations. Fewer clients, less stress, and his margins jumped from 12% to 27%. Sometimes doing less makes you way more money. Remember the 80-20 principle? 80% of your income comes from 20% of the work you put in, if, of course, you do things smartly. The fourth strategy is pricing psychology. If you're still giving single number bids, you're seriously not doing yourself a favor. People don't buy price, they buy value. Try the gold, silver, bronze approach. Bronze is your basic option, no standard materials, standard timeline. Silver is mid-grade materials, a 10-year warranty. Gold is premium materials, design consultation, priority scheduling. I had a bathroom remodeler use this method, and the result was insane. 60% of clients choose the silver option, 25% picked gold. Average margin per job rose from 18% to 29%. That's because when people see choices, they feel like they have control, and they almost always pick the middle option. But here's where a lot of contractors make a huge mistake. They focus too much on markup instead of margin. Let's break that down. If you buy materials for $1,000 and apply a 30% markup, you are charging the client $1,300. Sounds good, right? But your profit margin isn't 30%. It's actually 23% because the $300 profit is based on the new total, not just the cost of materials. Now, let's say instead of a 30% markup, you structured your pricing for a 30% margin. So in this case, it would be $1,428 instead of charging $1,300, ensuring that 30% of your final revenue actually stays in your pocket. See the difference? Most contractors undercut themselves because they confuse markup with margin. They assume a 30% markup means 30% profit, when in reality, they're shorting themselves thousands of dollars per job. So when you're structuring your gold, silver, bronze pricing strategy, make sure you're calculating for true margins, not just applying a markup. Plus, if you create pricing strategies this way, you are able to provide transparency for both yourself and your customers, giving you more control over what the project entails or covers. It's a win-win, which also prevents clients from taking on demands that fall outside of the scope of that package that they select. When you apply strategic pricing psychology, accurate margin calculations, and anchoring tactics, you can for sure increase profitability without having to work more. You just need to charge correctly. The final strategy is embracing the tech to save time. Time is money, especially in construction. Let's say you spend 3 hours a week chasing down change orders. That's 156 hours a year, almost a full month in unpaid labor. Now imagine using project management software to automate it. I had an electrical contractor do this and reclaim 10 hours a month. At $150 an hour, that's 18 grand a year in billable time recovered. But time isn't the only thing slipping through the cracks. Your budget might be too. One of the biggest reasons contractors go over budget isn't just rising material costs or labor overruns, it's a lack of real-time cost tracking. If you're still tracking expenses manually or waiting until the end of the month to review costs, you're playing defense instead of offense. Let's say you estimate a job at $100,000. Midway through, you realize material costs have increased by 15%, but you didn't adjust in real time. Now you're eating that extra $15,000 instead of passing it to the client. The solution? Cloud-based job costing. Tools like Buildertrend or JobTread allow you to track costs in real time, flagging overruns before they spiral out of control. You can see exactly where every dollar is going, adjust pricing on the fly, and protect your margins. And it doesn't stop there. Drones for site surveys can cut costs by 40% by reducing human error and improving efficiency. Automated invoicing reminders can get you paid faster because, let's be honest, chasing clients for money, it shouldn't be part of your job. The more you automate, the less time you waste, the less you and your customers forget, and the more money stays in your pocket. One last thing, data doesn't lie. The best part about leveraging tech is that it gives you hard numbers to work with. You'll finally find out how much time is your crew really spending on site, which jobs are actually the most profitable, which suppliers are costing you the most. When you have real-time insights instead of gut feelings, you make decisions that actually grow your business, not just keep it running. So if you're serious about protecting your profit margins, stop relying on guesswork. Embrace automation, track your numbers daily, and put your business on autopilot where it matters most. Do these 5 key strategies and you are not just building structures, you are building wealth. If you found this helpful, press that subscribe button. If you're new here, comment. I'd love to know which key strategy stood out to you the most and what you plan to implement.